In this episode, you're going to learn how to build an income-generating portfolio in 12 easy steps. Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. Let's get started. You're going to learn how to build a stock portfolio safely and reliably, and a stock portfolio that's going to provide you with consistent, growing passive income from dividends. So let's get started with step number 1. Do you understand the product or service offered by the company? If you don't, skip it. Move on to another stock. You have to have a basic understanding of how a company is making money. You don't need to be an expert in how they're doing it, but you should be able to explain it to your grandmother or explain it to a 12-year-old on how a company is making money. For example, up on the screen here, you can see the logo, Coca-Cola. Everybody knows how the company is making money. They're producing drinks, beverages, soft drinks, water, teas, juices, any type of beverages, and then they are selling them to consumers. And that's how Coca-Cola makes money. So step 1 is very important. You have to understand how a company is making money. Again, if you don't, skip it, move on to another stock. Step number 2, will people still be using this product or service in 20 years? You're going to be investing your hard-earned money into these companies, into these dividend stocks. So you want to make sure that the company is going to be around for a very long time. You want to stay away from companies that are producing items that are fads, something that's temporary, that may not last, that people may not be using for the long term. Skip it. Move on to another company. We want to invest in companies that will be around for a very long time. Step number 3, does the company have a low-cost, competitive, lasting advantage? So let me show you with an example. I'm going to use Warren Buffett's example of how he explains step number 3. So think of a company or a corporation as a castle. And around the castle, there's a moat. And the wider the moat, the deeper the moat, the better it's going to be to protect itself against competitors. So let's take a look at a real life example. You can see up on the screen here the logo for McDonald's. This is another logo that is international. The company operates in over 120 countries. They've been around for a very long time, and it is instantly recognizable. And this company has brand loyalty and a low-cost competitive advantage, and it keeps competitors away. It's a company that's going to make you cross the street, even if there's a burger joint right next to you. You're going to cross the street if you are looking to buy a Big Mac. There's only one company in the world that can provide you with a Big Mac, and that's McDonald's. And so for someone today to start a company from scratch to compete with McDonald's internationally, you would have to spend billions and billions of dollars in marketing and advertising and billions of dollars in research development, coming up with products, and you still wouldn't get to where McDonald's is today. Just the brand, the reach of this company is enormous. So step number 4, is the company recession-proof? Now let me ask you a question. If there's a recession, or there's a chance there's a recession that's coming up, and there's a chance that you may lose your job, are you going to go out and buy a brand new car? Of course not. Right? And that's why we don't invest in car companies. And you'll remember in March of 2020, when COVID hit, General Motors cut their dividend to 0. So we want to invest in companies that are recession-proof. Think about the product and services that you still have to use, even if there's a recession. Even if you lose your job, you still have to eat. You're still going to brush your teeth in the morning. And if you live in a cold climate, you still have to heat your home. And when you come home at night, the first thing you do is turn the lights on. So we want to invest in those companies that are not cyclical. Right? We don't want the value of our investments to go down. Right? We want to make sure that it's steady and it's growing over time. So again, if a company is not recession proof, skip it. Move on to something else. Step number 5, is the company profitable? And we can check this by 2 things. So it's really step 5A and step 5B. So let's look at the first one, step 5A. We want to make sure that the 20-year average earnings growth is 8% or more. Okay, so that's important. If the earnings growth, earnings is the profits of how much money the company is making. So EPS, you can see it on the screen, earnings per share. We want to see the earnings growing over time. So it must be at least 8% or more. If it's less than that, skip it. Move on to another company. Now we take a look at step 5B. The earnings per share must have increased at least 8 times in the last 20 years. If not, the company fails this step. We skip it, move on to something else. So let's look at 2 real-life examples here. These are actual companies. I've hidden their names to protect them, but you can see the 2 graphs on the screen. The first graph, and in both of the graphs, we're showing the earnings per share. So how much profit is the company making every year? And we're covering a large number of years. We're starting at 2008 all the way up to 2022. So if we look at the first graph at the top, what does it look like? It's going up and down, up and down, up and down, up and down. And you can see some years, like in 2015, the earnings were negative. And when the earnings are negative, the company is losing money. And then we see that happen again in 2018. We see it happen again in 2020. So here's a company that makes money, then they lose money. Then they make it, they lose it, they make it, and they lose it. So looking at the first graph, we have no confidence as to what's going to happen in the next 5, 10, 15, 20 years, right? We can't predict the future. Nobody can. We can't accurately predict it, so we don't know what's going to happen. So if you were to invest money into this company, $5,000, $10,000, $20,000, or $100,000 in this company, we don't know where the company is headed in terms of its earnings. Now look at the graph below, and you can see that it's a steady increase. The line is going up over time. The earnings are going up. So the company is profitable and the earnings are growing. So again, nobody can predict the future, but if I look at the second graph on the screen at the bottom, I can have a high degree of confidence that this company will continue to grow its earnings over time. So those are the kind of companies that we want to invest in. Now let's take a look at step number 6. The 20-year average dividend growth must be at least 8% or more. Now, I've been doing this for over 20 years as a dividend investor, and what's important to us is the dividend income. Remember I talked about passive income in the beginning? That's how we're going to get our income, and we want that income to grow over time. So we're looking at the history of the company, the last 20 years, we want to see the dividend growing over time because that's going to put more money in our pocket. Now, for some of you that are new listening to this episode for the first time, very quickly, what is a dividend? The dividend is simply the company sharing its profits with you, the shareholder. And in this example, if a company is paying a dividend of $1 per share and you own 1,000 shares, you'll receive $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend. The dividend gets deposited as cash into your trading account. So you can spend the money if you wish, or you can reinvest it. And as dividend investors, that's what we want to do, is reinvest it into other stocks that are paying us dividends. And that's how we can grow our passive income. Now, for a company that has a history of growing its dividend, then we have even more confidence that our passive income is going to continue to grow. If you look at a company like Coca-Cola, they have over 49 or 50 years, consecutive years of growing their dividend. And they've been paying a dividend since the 1800s. So that gives us confidence. Now we're going to look at the same graphs that we looked at before, but now what we're doing is we're looking at for example, in this particular example, if we were looking at the dividend per share. So if we see, like in the first graph, the dividend goes up, dividend goes down, up, down, they cancel the dividend, then they pay the dividend. Again, no confidence. What's going to happen 5, 10, 15, 20 years from now? Are they going to pay a dividend? Are they going to reduce it? Are they going to eliminate it? We don't know. What we want to see is something similar to the graph down below where we see it growing. So like the example I gave with Coca-Cola, I believe it's 49 or 50 years of consecutive dividend increases. So as long as the dividends keep going up, that gives us confidence that next year the company will increase their dividend again, or at least keep it the same. And that's what we're looking for. Ideally, we want the dividend to grow. Step number 7, the payout ratio must be 75% or less. If it's higher than that, skip it. Company fails step 7, move on to something else. So for those of you that are new, what is the payout ratio? I did cover this in the full topic in a previous episode, so go check that out. But for now, we're going to cover this quickly. The payout ratio is the annual dividend divided by the earnings per share. So let's take a look at example of company A. So this company earned $4 per share. So that's the profit, earnings per share, $4 per share in 1 year. And in that year, they paid a dividend of $1 to the shareholders. So that's pretty good. They made $4 and they paid $1 to the shareholders. The rest of the money they kept, they reinvested back into the business to grow the business. So you can see the payout ratio. We take the dividend, which is $1, divided by 4. We want to express that as a percentage, is 25%. So 25% of what the company made, their profit, they paid to the shareholders. So this is good. This means there's room for the company to grow the dividend next year. They can go to $1.10, $1.20, even $2. That's good. There's room for them to grow the dividend. Now let's take a look at company B. Company B earned $1 per share, but they paid the shareholders $2. How is this even possible? How does this make any sense? I'm going to say that again. The company only made $1 per share, but they paid $2 a share to the shareholders. So where did they get the money? Well, they ended up borrowing it from somewhere or using it from their cash reserves. And in this case, you can see that the payout ratio is 200%. Remember, dividend divided by the earnings per share. So all things considered equal, if you were looking at investing in company A or company B, which one would you invest in, A or B? You'd want to invest in company A. Their payout ratio is low. They have room to grow the dividend. Company B cannot sustain the dividend. They're either going to have to reduce the dividend or eliminate it or grow the earnings by quite a bit. In this case, they'd have to more than double their earnings in this example. So it's highly unlikely, and that's a risk we don't want to take. So remember, step number 7, payout ratio, 75% or less. Step number 8, the debt must be 70% or less. And here we're looking at the debt to equity ratio. So I'm going to give you another example. Let's look at company A. The long-term debt to equity ratio is 5%. Company B is 800%. Now, you don't have to be a genius to figure this out. All things considered equal, would you rather invest in company A or company B? And the answer is company A. Why? Because the debt is much lower. It's 5% versus 800%. Now, I know 800% sounds like a lot. It is a lot. There are companies today that are trading on the stock market that have a debt of 5, 6, 7, 800, or even more. And they trade on the market every day. We want to avoid those companies. The risk is too high. If we end up in a recession, a market crash, or interest rates go up really high, company B is going to have a very hard time paying off those loans. The interest alone is going to be extremely high. So when there's a recession or the market crashes, companies like company B are going to have a very hard time surviving a market downturn. So all things considered equal, company A is going to be the better investment. So remember, we want to stick with companies Companies that have low debt. Step 9. Has there been a recent dividend cut? If so, we want to avoid any companies that have recently cut their dividend. Because when they cut their dividend, that's an indication to us, it's a yellow flag, that something might be wrong there. Either the company's, obviously, 9 times out of 10, the earnings have dropped. So the dividend is not sustainable. The company has run into financial trouble. And so we don't want to be investing in companies that are in financial trouble. So if a company has recently reduced their dividend or cut it altogether, don't invest in that company. Right? So that's step number 9. Skip it, move on to something else. Step number 10. Does the company actively buy back its shares? Now, generally, for investors, it's a good thing. If I already own shares in a company and a company is now actively going to buy back its shares in the open market, that means the number of shares that are outstanding is going to come down, right? The number of shares is going to get reduced. And because the number of shares are going to get reduced, the shares that are still out there that are existing and the ones that I own, hopefully over the long term, the share price is going to go up. They're going to be worth more just because of supply and demand. So there's less shares available. The ones that are out there will be worth more. So generally, we want to look at companies that are actively buying back their shares over time. Step number 11, is the stock priced low? In other words, is it undervalued? So there's 3 things we need to check here. So step 11, it's in 3 parts, A, B, and C. So let's take a look at the first one. Step A is looking at the PE ratio. Okay, so let me explain what that is. It's the share price divided by the earnings per share. So if we take a look at company A, the company earned $4 per share. So the earnings per share is $4. The share price is 32 today, let's say in this example. So if we take the share price divided by the earnings, so 32 divided by 4, that's 8. So company A has a PE ratio, price to earnings ratio, of 8. Now let's take a look at company B. Company B also earned $4 a share. Now, in this example, let's assume they're in the same industry. They build the same products and services. So the earnings are identical. So company B is also earning $4 a share. But the share price is $380. So now if we take 380 divided by 4, that's a PE ratio of 95. So all things considered equal, which company would you rather invest in? Company A or company B? Company A, of course, because the share price is lower. In this example, if we were to compare both companies, all things considered equal, company A seems to be undervalued compared to company B, right? So we don't want to overpay for companies. So that's important. Okay, so 11A, we want to look at and make sure the PE ratio is 25 or less. If not, skip it. Move on to another company. Now let's take a look at 11B. The current dividend yield must be greater than the 20-year average dividend yield for a company. Now, for more information on that, how do we come to that formula and the background on that, please go back and watch episode number 1. I cover that in detail. So you'll learn exactly why we come to this formula where we're looking at current dividend yield greater than average dividend yield. If this is true, then a company is undervalued. If it's the other way around, where the current yield is less than the average, then we know the stock is priced high, right? So that's one thing that we want to check as well. Now let's go to the last part here, 11C. 11C is to make sure that the price to book ratio, the PB ratio, is 3 or less. So the price to book ratio is simply the share price divided by the book value per share. Let's take a look at company A. So the share price, again, $32 a share. The book value is 16, so 32 divided by 16, that's 2. So this company has a PB ratio, price to book ratio of 2. Company B, share price is $380, also has a book value of 16. And now we see that the PB ratio is 23.75. So all things considered equal, and again, we're assuming the companies are in the same industry, the same growth rate, the same dividend, the same debt, everything else is the same. And in this case, the book value is also the same. The book value is what the company is worth if you were to, if they were to go bankrupt, you liquidated everything, all of their factories that they own, their office space, any vehicles, any machinery, computers, desks, all of that. That's the book value of what the company is worth, the value of what they have. What is that true worth? So that's the book value. So in both cases, the book value here is $16 a share, but company A is trading at $32. Company B is trading at $380. All things considered equal, would you rather invest in company A or company B? And again, we want to invest in company A because this is showing us that in this example, company A, the stock price is low compared to company B. So remember, we want to invest in companies that are priced low. We don't want to overpay for companies. Now let's look at the very last step, step number 12. This has nothing to do with looking at stocks, the stock data, or looking at companies. That has everything to do with you, the investor. You want to make sure that when it comes to investing, you want to keep your emotions out of investing. I know it's hard to do. It's very easy to become emotional, especially when it's your hard-earned money that you're investing. But you don't want to have any knee-jerk reactions, right? The key here is to be patient and disciplined. Patient to ride out market downturns as they occur, and the discipline to stick to the 12 steps. Only invest in companies that pass all of the 12 steps, not just 10 out of 12 or 8 out of 12, all of the 12 steps. And I don't want you to do this. You can see this up on the screen here. Stock prices go up and down all the time. When prices are going up, people get greedy and they start to buy more and more and more shares. Right? We don't want to be buying when prices are up. They're overvalued. Remember, step number 11, we only want to invest in companies when they're undervalued, not when they're overvalued. And then when prices start to drop, everybody panics and people just start to sell. And you don't want to do that either. You don't want to sell when prices are low because then you solidify your losses. So I don't want anybody doing this. And you can see it up on the screen. Don't buy when prices are high and don't panic when prices drop. So you have to maintain your patience and discipline. And I've said this before many times. If there's any money that you need in 5 years or less, whether it's a down payment on a home or to save up for a car or a vacation or even an emergency fund or children's education, if it's any money that you need in 5 years or less, do not invest it in the stock market. And that means do not invest it in mutual funds, index funds, and ETFs because they just turn around and put that money back into the stock market. Why? Because in the short term, the stock market does this. It goes up and down, up and down, up and down. And so if you've got $20,000 invested and you're hoping in 3 years the $20,000 is going to be there, and if it's only worth $12,000, now what are you going to do? Are you going to sell it at $12,000? It's a huge loss, and the money isn't there. So anytime we're talking about investing here, the 12 steps, any of my episodes where I talk about investing in dividend stocks, it's money that you don't need for the next 5 years. And the longer you can stay invested, 10, 15, 20, 30, 40, 50 years, even better. The longer you stay in the market. Because in the long term, the stock market has done this. And it goes up and up and up. Okay, so we started this episode by talking about building a dividend stock portfolio safely and reliably. And a portfolio that's going to provide you with consistent, growing passive income each year. So I've been doing this for over 23 years. My value of the portfolio has gone up and down, but the dividend income that's being generated has grown every single year for the last 23 years. And that's what we're looking for. So how do we do this? Our approach to investing here at Simply Investing, and my approach, is to invest in quality dividend stocks when they're priced low. So when you're looking at a stock, how do you know if it's a quality stock and how do you know if it's priced low? Well, we just covered all of this today in this episode, which is what I call the 12 rules of Simply Investing. I've been calling them 12 steps. It's the same thing. It's the 12 rules of Simply Investing. This is your checklist. You want to make sure that a company passes all of these 12 rules before you invest in it. Even if there's one failure, skip it. Move on to another company. So for those of you that are interested, I cover all of these 12 rules, the 12 steps, in the Simply Investing course. I also provide you with a Google spreadsheet that you can fill in all the numbers. The spreadsheet helps you figure out if a company passes a rule or if it fails a rule, and you can apply these to any stock anywhere in the world and figure out for yourself, is this a company worth investing in, or is this something I should skip? Also covered in the course are the following 10 modules. So it's more than just the rules. So we cover with you the investing basics. In module 2, we cover the 12 rules. In module 3, we apply the 12 rules with some real life examples, step by step. Module 4, I show you how to use the Simply Investing platform. Then I show you how to place your first stock order, again, step by step. In the next module, I show you how to build and track your stock portfolio. And I give you all of the tools on how to do the tracking yourself without having to pay someone else to do that for you. The next module, when to sell. So it's important to know when to buy. It's important to know when to sell. So we cover that in that module. The next module, I cover reducing your fees. If you still own mutual funds, index funds, or ETFs, how do you reduce those fees? And overall, how do you reduce the risk of your dividend stock portfolio? And then module number 9, your action plan. So I'm going to give you a step-by-step action plan so you can get started right away. And the last module, I answer your most frequently asked questions. So this is a complete course, end-to-end, 10 modules, and we cover it all. Now, for those of you that are interested, I also have the Simply Investing platform. What the platform does is it applies these rules to over 6,000 companies in the US and Canada every single day. And so you can immediately see which companies pass all of the rules, which companies fail which rule. And so you can see, here's a company that I should avoid, and here's a company that I should consider investing in. So the platform does all of the homework for you, and we filter out the entire 6,000 stocks every single day and present to you which stocks you should be considering. Now, for those of you listening to this podcast or watching this podcast, you want to make a note of the coupon code SAVE10, SAVE10. SAVE10 is going to give you 10% off of all of our products and services at Simply Investing, and the benefit is obviously with the course, 10% off. With the platform, as long as you remain a subscriber, whether it's month to month or year to year, you'll get 10% off at every renewal, ongoing. So that's a huge benefit. I hope you enjoyed this episode. If you liked it, be sure to hit the like button or follow us. Hit the subscribe button as well. For more information, go to our website, simplyinvesting.com. Thanks for watching.